Thank you, Ethan and Charlie. As we've mentioned throughout the webinar, and Ethan linked to the resources, including the discussion paper, the Lifecycle modeling tool, they're all available through www.nhc.org/Lifecycle. And if you have any questions for us about the webinar, you can use the question panel to the right. Following the webinar, you can contact us at chp-feedback@nhc.org. And we also have on the nhc.org or www.nhc.org/Lifecycle page, there's a link to a housingpolicy.org forum thread so that people who have questions 1 month can see people's prior questions from the month or several months before and have them all archived in an ongoing conversation. So now that I've given you all a little bit of time to start adding in more questions, and feel free to do so throughout, let's start going through some of the ones that have come in. So one of the questions is about the technicalities. So Charlie, there's a question about the debt. Is a property's debt reduced through a longer period or lower payments in your in your thinking through life cycle underwriting?
The software would allow you to test a number of different approaches. So lower interest rate would be one. Shorter or longer amortization period would be another one. A smaller amount of hard debt, which would result in a lower payment and therefore more availability of cash flow, is another option. And the hard debt screen in the software would allow you to do those sorts of what-if analyses.
So we also had a question about life cycle underwriting versus capital needs assessment, and the gist of it is, how would an agency know if repairs are necessary if there's no capital needs assessment? And just want to make it very clear that we all, and Charlie or Ethan, you can feel free to jump in here too to hammer this point home even more, but we all feel that this is no replacement for a capital needs assessment. You really need to do that to understand your specific property. This is really general estimates and projections about likely capital needs overall, but not specific to your property.
Maya, this is Ethan. Yeah, I think that's right on. I would say that this is more of a complement to a capital needs assessment rather than a substitute. Right now, developers have their own internal models for thinking about, would a deal even be feasible, right, under whatever circumstances. Lifecycle is a way to start thinking through that with the 50-year lens. Lifecycle doesn't go to your property. It doesn't look, under the building, on top of the building, behind the nice facade and see what's crawling around in back and how old the systems are. So it's only as good as the data that are put into it. And the capital needs assessment also performs a different function in terms of letting third parties know and how a property both is operating and could operate in the future. Whereas Lifecycle is really, it's user supplied and then user consumed information. It doesn't. There's no verifiability about it. So the CNA is a different animal. I would say if we were doing more 50-year underwriting, more life cycle underwriting, in general, people would probably be buying more capital needs assessments because you need to take that longer-term look.
So we have a question about applicability to scattered site housing projects, and this is really about multifamily affordable rental housing. But Charlie, have you given any thought to what adjustments in the data or the approach might be needed to try to think about scattered site in this way?
Just thinking about it, if you wanted to use L-cycle in the context of a scattered site property, I think the property you'd want to describe in L-cycle would be the average units, so that if some of your two-bedroom units are 800 square feet and some of them are 900 square feet, you'd want to tell L-cycle that your typical unit is somewhere between that. And I think you could make it work. And of course, to jump on the previous question, the capital needs assessment becomes even more important when you're doing an acquisition rehab property as opposed to new construction, and I think it goes to an even higher level of importance when there's a scattered site property, because those are much harder to understand, and the value added from having the third-party professional look at the property would be even higher. So as you start going down that complexity curve, I would be more inclined to look at a capital needs assessment rather than less inclined.
Charlie, one follow-up question. This is Ethan. L-cycle has the ability to look at portfolios, at least in some sense. So if you had a scattered site and you wanted to put in, all the details for each unit, you could, right?
Right. You could do one L-cycle entry for each of the sites. That would be another way of going at it. And you'll find when you start using L-cycle that you can get results very quickly. It's not cumbersome to use, and it doesn't require a lot of data entry. So you can get to answers and get to the interesting what-if parts pretty quickly.
So we have some more L-cycle software questions, and maybe I'll just try to run through some of those so that we can talk about that all together. Can it be used for single family, or is it only applicable to multifamily? And that we sort of covered, but the how you might have to modify it, in some of the tweaks. We've tried to make the back end pretty accessible for doing alternative scenarios. But Charlie, could you just add another note about that?
That's not a question that we considered, and we can certainly take a look at it offline. I can't think of any reason why it wouldn't work for single family, but we've never tried that, so I wouldn't speculate on whether it absolutely would work.
Mm-hmm.
I don't see anything at the moment for why it wouldn't.
So we had another one of the L-cycle questions was really about getting access to some of the. See the exact content of the question was about getting access to this in an Excel sheet, and one of the options is actually to export this as Excel. So you might be able to integrate it into some of your analyses that way, and tweak and look a little bit more. You can download PDFs that include the graphs. You can also download full Excel sheets and really note all of the terms and alternative scenarios and be able to tweak them a lot yourself. We've tried to make this a very accessible tool that's really for your use. You do have to register to use the tool, but there's no charge or anything. The registration is essentially because you're putting in your property's financial data, and we want to make sure that, one, it's not a cumbersome amount of data, but if you were going to look at it again and again, you'd want to be able to continue accessing it, but you also don't want everybody to be able to access it. So, Charlie, is there anything else that you'd want to say about the Excel or the outputs there?
Well, I think it is worth mentioning that you can save not only the properties that you've created in L-cycle, you can also save any custom assumption sets that you create. So if you were going to become a power user of Lifecycle, you'd have a lot of ability to store custom settings as part of your profile. And we hadn't talked about that before, so I'm glad you brought it up.
Yeah, so that's a great segue into one of the questions about customizing for local markets. So if there were assumptions that we made on a national level that don't fit the assumptions in your community, you can change those assumptions, save that set, and be able to use it that way. Another one of
Yes, for example, the assumptions we make about mortgage interest rates that would be available at the time of refinancing, the assumptions we make about inflation rates, the assumption we make about the interest rate that's available on replacement reserve balances, and also the useful lives of the building systems and the replacement costs of the building systems. All of these can be accessed by users and customized if you want to. The existing settings we think are reasonable, and the useful lives and replacement costs came from one of the better-known capital needs assessment providers. So we think it's pretty good information, but certainly you can adjust it to fit your circumstances pretty easily.
And Charlie, do you remember if it works? I think you use a Mac, if I'm remembering correctly, but it works in Safari and a variety of browsers we've tested, correct?
We've tested a number, and it works on iPads. So the software is reasonably robust. If you're running into compatibility problems, by all means let us know. But it's been reasonably well tested.
And can you talk a little bit about the inflation factor for projected replacement costs?
There are several inflation rates that are built into the economic assumptions. There's one for rental income. There's one for the replacement reserve annual deposit. There's one for the replacement costs, and I think those are the basic ones. And all of those are under user control. I think the standard assumption, it's either 2.5% or 3%, and then in the standard set, rents inflate a little slower than general inflation, and everything else inflates pretty much at the rate of general inflation. But all of that is under user control if you want to try something different.
So we also had a number of questions about this whole idea of a 50-year affordability period. So I think it was Ethan who said it's very hard to make plans over 50 years. So that's very true. And one of the attendees asked, so if we can barely plan for the next 10 to 15 years, how can we commit to promises of affordability over such a long term? Do you have any thoughts about that? I think this is something that both Charlie and Ethan would probably want to weigh in on.
Sure.
Well, I'll say a
little bit. Let me take a stab at it.
Yeah, go ahead.
Or Charlie, go ahead first, please.
Okay. One thing is to acknowledge that all of us think this is a real issue. That it is difficult to plan for a long period of time. That said, here are some things to think about. If I'm thinking about it from the viewpoint of a public funder who's being asked to make a little bit more of an investment so the property will be sustainable longer, I will probably want the option to require the property to be affordable for a longer period of time. And maybe I would agree that we can look at it after 30 years and decide whether the property is still needed. But I might logically want to negotiate for some longer affordability period in exchange for making a somewhat larger initial investment. So that's one way that this might come into play. The other way that may come into play is in talking to public funders. All of them would like to have more ability to keep properties affordable for longer, as long as they're needed. And so I think there's a general trend in the funding community to think about longer planning horizons for affordability rather than just assuming, well, 10 or 15 or 20 years is good enough and we can worry about re-preserving at the end. That is, in my conversations with funders, I'm seeing them thinking about maybe we should be thinking about longer affordability commitments from the beginning rather than making it up as we go along. Ethan?
I would agree with everything you just said and add 2 more points. One is that, yes, we have difficulty planning 15 years out, but when you build a property, it's there. And it's going to be there way longer than 15 years, barring some, casualty, stroke of lightning, fire kind of thing. So the fact that the property will be there shows us that we might as well be planning to take care of it. And since it's being created as an affordable asset, there is, a pretty compelling logic from a public sector point of view for making sure it works over that long period of time. Second is that, I would even take your point a little further, Charlie, and say there are a bunch of public entities at the federal and state level who require far longer than 30 years of affordability to do a deal. Right? There are places where 55 years of affordability is standard. I have seen 99-year affordability. I've seen some places talk about permanent affordability, which has its own challenges. But if we're asking for that commitment for use of the property, we should be underwriting to make sure that it's possible, because in many places the preservation risk is as much about the property not being operable, not being able to provide the safe, decent, affordable housing it should, as opposed to it turning into market rate housing and the rents going up and people not being able to afford it. So if we're asking properties to do it and the sticks and bricks are going to be there regardless, it makes sense to have a thoughtful conversation and decide how and whether we want to make that whole long-term perspective work better.
Let's think a little bit too about lending, getting money for a 50-year period. As we've had some questions come up about, banks who's willing to lend for that period, and jurisdictions not allowing capital money to be lent longer than 30 years in some cases. We're not talking about getting a 50-year mortgage for a property. Let's Charlie, can you talk a little bit more just to clarify what some of the background assumptions are here?
Yes, and I think I would turn that previous point on its head, is to say that if anything, we're talking about shorter debt instead of longer debt. That one of the things that has jumped out at me is that when we think about using, say, a 40-year mortgage loan, that's actually kind of dangerous when you consider that the big onset of capital needs happens at year 30, when you may have only paid off half your loan. So one of the things I particularly think of when I think of life cycle underwriting is shortening the amortization term on the first mortgage. And when I look at actual affordable properties, one of the things I notice is that usually they don't have that big a first mortgage loan to begin with. And the additional cash flow cost to shortening the amortization period is not that big. Whereas if you got to year 30 and you were completely free of hard debt, it would make a big difference versus having half of your original loan amount still outstanding. So I think generally I would think about shorter debt rather than longer. And I'm certainly not a fan of 50-year debt under any circumstances.
This is Ethan. I would agree with all of that and just add that part of the thinking here is there are multiple loans during the life cycle of a property, and the refinancing process should get easier, which means it would be more attractive for lenders to participate in, be simpler for borrowers, just less brain damage overall.
So, thanks for helping us think through this. We also had some questions about return on investment and whether, where do the subsidy savings come from aside from avoiding the costs of complex recapitalizations. What is the impact of doing life cycle underwriting on an owner's cash flow, the incentives for developing housing, and what do we think a reasonable return on investment is? So can you touch on that a little bit, Charlie?
I'll touch on it briefly, and I think Ethan will want to say something as well. First thing is to say that if at the moment developers are thinking that they make their money two ways, one is through original development and one is through recapitalizing the properties or doing another tax credit round 15 or 20 years later, this would involve a change in the thinking. You have to think about making some of the money up front, making some of the money from cash flow, making some of the money from a share of refinancing proceeds that isn't needed to keep the property going, but not so much thinking in terms of a big, expensive recapitalization every 20 years. So it would require some rethinking, and different developers are going to have different viewpoints about what that means. Now, the second thing I'll say before turning it over to Ethan is that the thrust of life cycle underwriting is to have a little bit more cash flow capacity in the property. So generally, you would be thinking about a greater allowance for rent loss, a greater annual reserve deposit, maybe a greater annual debt service coverage ratio. And all of those things tend to result in more cash flow, which means that developers under life cycle underwriting might have more opportunity to earn returns from annual operations than is the case at the moment. So, Ethan, you probably will want to add some things to that.
I do, although I think you've really gone right to the heart of it. This is about shifting thinking, not just by developers, but by everyone involved in the whole ecosystem that creates the housing. And I think there are real benefits to not have, from a public sector perspective and from a developer perspective, to not have most of the return concentrated in rare events, right? If instead of having most of the value at initial development come out of a fee and little or none come from cash flow, the way it often is in the status quo, but have more return over time from better operation and management of the property, it aligns everyone's incentives a little bit better. The owner-manager has an even stronger incentive to be efficient and effective and to safeguard the property over the long term. The public sector regulator has more incentive to work carefully and well with the owner over time, as opposed to focusing all of their efforts on trying to figure out a complex transaction and make sure no one's getting too much money and the property's getting taken care of and the community's getting taken care of and all the pieces are aligned there. Instead, there's more of a confluence of an alignment of interests over time, and I think that's some of the value. It also means it's complicated, and there will be negotiations that have to go on. I acknowledge that the questioner said, "Hey, what's a reasonable rate of return?" And I'm certainly not ready to put a percentage or a number on that. And I think there's been a complicated history with, for instance, HUD-regulated properties over time of designating what a reasonable return is. One of the appealing things about a life cycle underwriting approach is that it puts more of a rigorous basis for understanding what the property's capital needs are, what it costs to, in effect, buy that affordability month on month, year on year. And that really would inform a conversation about returns and access to equity and what is reasonable and what still protects both the property and the owner's interests and the interests of residents. So it's, not a something we have solved, but I think it is a conversation that becomes easier in some ways with a life cycle approach, not necessarily less complex or less, negotiated, but one that can produce better outcomes if we all engage in it.
We also had a handful of questions that dig into getting this actually implemented and off the ground. One person asked about whether any state housing finance agencies or agencies that administer tax credits have seen the life cycle underwriting idea and indicated that they would use it to, think about replacement reserve requirements or other needs. Another asked about selling the whole concept to developers who are focused mainly on just getting the deal done in the first place with a situation where we've got a lot of limits on the financial resources at the initial onset. And another asked about policy changes that would need to happen to implement these recommendations, and that's kind of a host of questions, but we're at 2:48 and we want to try to close at 3 and let you all get back to your lives. So is there anything, let's say first Ethan, since this is really on the policy and practice side, and then Charlie, if you have anything that you feel like you need to add in, please do so.
Sure, and I expect Charlie will have a bunch of thoughts for us. Let me take a stab at 3 really good questions. First, by saying these are exactly the questions we want you to ask and think about. Our goal with this webinar and with the paper and with the research and the software tool is not to say we have the answer. It's to get everyone thinking about, well, how, if this is a direction we want to go, how do we get there? So it's a slight bit of a cop-out, but yes, you're asking the right question. Second, I would say that there are state agencies, and I think that question is right in identifying a state agency as a major moving part here, because they're the ones that put requirements on a lot of the public resources that go out, that choose which properties get it, that do a lot of the asset management over time, right? They're a nexus for all of this activity. They would be a motive force in shifting the paradigm to a life cycle underwriting one. I think it's right to identify them in that way. There are agencies, and I'm going to speak only from my experience, not in an exclusive way, but in an exemplary way, that are starting to think through the long-term capital needs implications and monitor that carefully over time. I'll pick out the state of Michigan. I know some of those folks are on the webinar right now because they do periodic capital needs assessments of a bunch of properties in their portfolio to see not only initially at the time of an allocation of credits or an allocation of loan funds what's needed, but is it on track? Is the property meeting projections? Is it exceeding them? Will it need help later on? Is it something to watch? Is it something that's doing great? Right? You need a tool to monitor that over time, and L-Cycle is not the answer to that, right? It's one thing among many that would be used in that process. So I wouldn't say that any state has said, oh yes, we're going to do 50-year underwriting, but there certainly are states, Michigan just being one example, that are looking carefully at the capital needs as an ongoing thing as opposed to a projection you do at initial underwriting and then you forget about it because it was a hurdle to get past. Changing to a life cycle underwriting approach, as we highlighted in the discussion, does add initial cost. And I have worked with enough developers to know how much heartburn that can give you when you think about all of the moving pieces and all of the sources you have to assemble just to get any deal done, right? To get any brick placed on another brick is a really heavy lift. And the goal here is not to make life harder, but to think through from a public sector perspective what would make life easier over time if we made some real changes in how we do policy. So one thing that might well ease a transition is a temporary increase in the public resources devoted to affordable housing to prevent exactly the contraction that could occur if units cost a little bit more because you're underwriting long term. So those would be just my initial reactions to some excellent questions for which we do not have all the answers, but for which I think everyone's attention is warranted. But Charlie, I would love to hear what you think too.
I wanted to talk about 2 things that have come up in my discussions with public funders fairly recently. One is that lots of people, particularly in the tax credit world, are thinking hard about what they may call cost effectiveness or cost reasonableness, and one way to look at that is what's the amount of annual low-income housing tax credits that it takes to get one unit developed today, and is that a larger number than it was 10 years ago? And the answer pretty universally is that it is a larger number than it was 10 years ago, and that bothers a lot of people. So that may push against life cycle underwriting because there's already a concern that the properties we're producing are too expensive. The second conversation I'm hearing is about the gap between the need for affordable housing and the amount of it that we're producing. So no matter where you look, if you look at census data and you try to tease out what's the rate of increase in low and moderate income renter households, it's always a much greater increase than the number of new affordable rental housing units we're creating. So there's a lot of focus in the public funder world about how do we make the existing resources go farther. So the idea of spending a little bit more on each property to make it last longer pushes against that. But the idea of not having to re-subsidize the same property 15 or 20 years later actually supports a cost effectiveness objective. So that's a couple of ways where I think this is talking a language that public funders are already speaking to each other.
Thinking a little bit about public funders in a case of home loans, we had a question about how L-cycle would affect the repayability of home loan to a participating jurisdiction if the loan was only supposed to be repaid if there's cash flow. And adding on to that a little bit, let's think about other of the unintended side effects. And Ethan had brought one up earlier about about accessing the higher replacement reserve funding by trying to take that money out early. Let's think through some of the unintended consequences in a minute or two, because that's all it takes, right?
Sure, I can go first, Maya. I mean, I think the typical structure of home loan or some other soft funding is repayable from cash flow if there is any, and sale or refinancing when it happens, and it's designed mostly to be repaid, if ever, from cash flow or refinancing. I mean, in general, the purpose of soft funding is to be that. It's soft. It's as much an enforcement mechanism and a way to keep the public sector engaged with in a real economic way with the owner of the property as it is to actually repay the loan, right? If lenders of soft funds really wanted to get repaid and have the money all come back, they would be structured very differently. Not to say they're not supposed to be paid back legally. The point is it's designed as soft money, not hard money, and hard money is put out there because it's supposed to all come back, and then the lender makes new loans. Soft funds are designed to create affordability, to bridge the funding gap between what it costs to develop and maintain a property versus what rents for low and moderate income tenants can support. I think from a life cycle underwriting approach, you'd want to rethink how some of those soft funds are deployed. It may be that they are amortized quickly, or that there's a forgiveness period, recognizing that because you have a life cycle underwriting approach, you don't necessarily need the soft debt hook to maintain that ongoing engagement. There would be other regulatory mechanisms built in because there's more ongoing oversight, there's more sharing of cash flow between the owner's return and the property's capital needs. You would also think about as Charlie said, I think maybe I said this, the quicker amortization period of the hard debt and interacting that with the soft debt in the structuring approach. So it's a place where there needs to be real thinking and negotiations around individual transactions. But I would say it's part of changing from let's create debt as a hook, and more as finding ways to provide funding for the capital needs as well as return, as well as serving the public purpose over time. Charlie, you must have additional thoughts here, though.
Well, one thing that life cycle underwriting kind of brings up for me is a need for some kind of understanding among the various funders at the beginning of a project, that we recognize that it may be appropriate to refinance this property at some point, and we recognize that the first call on the refinancing proceeds should be the ongoing viability of the property, and that the owner shouldn't be trying to put needed funds in its pocket if the property needs them, and similarly the soft lenders shouldn't be trying to put the funds in their pocket if the funds are needed for the property. And a simple conversation along those lines early on would probably be a pretty useful thing, and would be something that I would think most people could have agreed to fairly readily.
I would agree with that. I would just say the conversation's never simple, but yes.
So we also had a number of questions that I decided to push off in the interest of letting this conversation really focus on implementation and the hard dialogue that needs to happen, as well as what you need to know to be able to use Lifecycle. And so I apologize that it's 2:58 and I haven't answered your research questions about the properties that didn't need any additional investment and how they've sliced and diced. Let me say very briefly that most of the time in the research budget for this whole project went towards the cost comparison and much less of it towards the life cycle underwriting piece. So there are a lot of different ways that we could have sliced and diced and looked at it, but considering the fact that we didn't have a fully representative sample, we didn't want to do too many slices and dices and think that we could say something that was meaningful. So a lot of you brought up good questions that may have implications, and we'll certainly look into them further. At this point, I'm going to try not to take more of your time. I want to thank all of those of you who joined. Thank Charlie Wilkins and Ethan Handelman and the full Lifecycle Underwriting and Cost Comparison Research team. And of course the financial support from the John D. and Catherine T. MacArthur Foundation that made all of this possible. If you have thoughts or questions that you'd like to add, please either post them to the housingpolicy.org forum discussion thread about lifecycle underwriting that you can find at www.nhc.org/lcycle. If you go all the way down to the bottom of that page, you'll see a link to the forum discussion. You'll also find all of the resources that we've been mentioning today at that same link. I'd also like to remind everyone to visit nhc.org to learn more about that 2013 Solutions Conference, where we'll have some demos. The link again for all of the Lifecycle stuff is www.nhc.org/Lifecycle, and the main National Housing Conference page is www.nhc.org. We're going to send you a thank you email that includes a link to the archived version of the webinar, the presentation, and there may even be a special Solutions Conference discount code as a thank you for all of you who've given us your time today. So thanks again for joining us. Now take your property data, head over to Lifecycle, put it in and see how lifecycle underwriting works for your own deals, and hopefully we can continue this discussion over email, online, and potentially at that Solutions Conference. So we'll be emailing you with more, and please email us as well. Thank you very much, and we'll glad to have had such robust question and answer period.